what are the different types of insurance? This is what we're covering in this section.
Money, mindset.
So this course is not designed to give specific advice and is only meant to provide information and financial guidance. There are plenty of good websites that you can do your own research. Before you take out any insurance, make sure you read the provider's terms and conditions. It would be devastating if you think that you're covered and then something terrible happens, only to find that you are not covered due to some term or condition in the contract. See a financial advisor if you're unsure about insurance or how much insurance you need. So first of all, check if you actually need insurance. So an example would be if you're single with no debt, your death, although it would be devastating for others, may not put others under financial burden. So if you're single and no one's relying on your income, you may not even need to get insurance. So ask yourself, do you have debt or dependents? So debt being credit cards or a mortgage, that if you died, that debt doesn't die with you. So it would need to get covered. So if you have a family house, for instance, having insurance to cover that mortgage would be a sensible thing to do. So you can cover this risk with insurance. The other urgent need of insurance, if you have dependents, so this is people reliant on you, your income. So this may be children, your partner, or elderly parents. So you can get insurance to cover this, to give you peace of mind and to cover them for if you die. So you may already have insurance. So if you're employed, then your work may provide a certain amount of cover. So it's worth checking before you take out an insurance. Check your employer, go to your HR department and check your contract to see if you actually have insurance before you actually take out. You don't want to double cover yourself. So if you're employed for, say, a FTSE 100 company or a large company, and you've been employed for a while, then it's quite likely you have a certain amount of cover or a certain amount of insurance in your contract. But it's important to check. So go to your HR department and they can help you there. If you work for a small startup company, it's less likely that you're going to have very good or any insurance. So it's worth noting about that. So let's cover what actually is insurance. So insurance is a collection of people all paying into a pot of a pool of resources. So this it pools risk together through insurance. So a population of people all pay their premium, this cost of insurance you pay each month, and with this insurance, the insurance company pays out if there's any high impact event of any of these people's lives. So some risks are best managed, like diversifying your assets, which we'll talk about later in this course, or other risk is best being insured, like death or illness, for instance. So the most common way to categorize the different types of risk is to look at how severe the impact and likelihood it will occur. So this may be a death of a parent or with young children. This event would obviously have a high impact on those individuals and their family. So having this cover comes in different forms. So your loved ones could get a lump sum, which means you'll get a big pot of money coming to you if you die, for instance, which that could be used to pay off your mortgage, or you could get paid monthly to cover the living expenses for your children or aging parents. So life insurance, so a lump sum on death is a common life insurance to have. So this is a one-off payment that you may be able to buy the house that you're paying mortgages on, so you don't need to pay that mortgage anymore. Or you could put that money aside for your children's university or to pay for living expenses. So the downside of this is that you get an additional problem of having to manage this money. Do you keep it all in cash or do you invest it? This is another kind of additional problem. You can cover the cost of the mortgage and you could pay off that mortgage in full, or you can choose to pay off the living expenses. So that's the lump sum. You can get a family income benefit, and this you get. If you're a family, you can get this. You get paid an income to the family if the main earner dies. That you get a payment every month until they are no longer dependent, which means they are once they reach 18, for instance, then they are no longer dependent, and that cover, you're not covered anymore. This covers that person's income to cover their everyday expenses. Another type of insurance is critical illness, and this covers if you get diagnosed with a certain illness, and in the different insurance companies have different contract. It's in the contract depending on which types of insurance, which types of illness is covered. So this critical illness covers, you get a lump sum if you're diagnosed with this illness, and check the policyholder depending on which types of illnesses they cover. This is important if you're self-employed, for instance. So income protection insurance is another type of insurance which provides a regular portion of one's income if you're unable to work. So long-term insurance policy is designed to help you if you can't work because you're ill or you're injured. So this ensures you can continue to receive a regular income until you retire or you're able to work again. This aims to replaces your income or part of your income if you can't work or you become ill, and it pays out until you can start working again. Another type of insurance is business protection. So if you own your own business, this is key person insurance. So if a key person, so someone who is deemed to be important in the business, if they die, you would lose their skills, their experience, their expertise. So it may take too long to be able to train up another person, or it may be too expensive to replace that person. So this would cause business interruptions. Future projects may be postponed or cancelled. Important business contacts may be lost due to not having that access to that person's network. So this you can cover this for this loss. So that's key person insurance. So while it's important to have cover, it's worth noting that there's a risk of over-insuring yourself. This, to use the football analogy, this means that you could have a team full of keepers. So if you've got all the keepers, you may not, a team full of goalkeepers, you may not score many goals, which means you're not going to get to your goal of being financially independent and able to retire. This is playing it too safe, and can it be dangerous in itself? So paying too much every month into insurance can mean you're not investing elsewhere and not actually scoring goals, building up that pot of money that for your investment. So just to summarise, the simple fact of life is that we all have a limited time to live. No one knows when they're going to die or get sick or injured, but we can be prepared to protect our loved ones if we do die, or if we get sick or injured. So if a loved one dies, it could be obviously devastating, not just emotionally, but devastating financially. So you can cover yourself or cover someone else if they're the main earner. So just think, how would your family cope if one or two of your parents die if they were no longer around to provide for the family? So protection can be, or life insurance, or critical illness cover, or income protection can cover either a lump sum or a monthly payment to whoever you choose to compensate for your loss, so that you may cover a loss of earnings if you're not able to protect that income. So just to summarise, make sure you do your own research. This is aimed to be guidance and not advice.
Money, mindset.